of kind of apna ghar.
All years for the governor's press conference. Someone who's been a veteran at reading the RBI's message is Manish Wadhawan, managing partner at Serenity Macro Partners. Manish, thanks very much for taking out the time and congratulations on the new venture.
Thank you so much.
What is it that you are going to be watching out for most from the RBI? Now, we know that we've got both inflation and growth indicators which have been gradually moving up. You've got on one side an indication that the government is focusing on growth. The other side, you've got inflation, where the RBI is saying we're only targeting inflation. Where does that leave us, reading what the government, what the RBI could do?
So first of all, to start with, today is going to be one of those boring policies. So don't get excited so much, as I think the markets were with the budget. It's a pause today. I don't think much has changed.
With an accommodative stance.
Yeah, with an accommodative stance. So nothing changes. And more so because it's the last policy in the current fiscal. We don't expect any major changes in the policy today. I think the focus would be more on the delivery of whatever they have committed in terms of the switches, etc., what they're talking about. In terms of the bond index, I think that's the most exciting thing for markets for maybe next 3 months to 6 months. And what we expect is today, inflation trajectory may be a bit adjusted a bit on the higher side, but RBI would go in for a long pause. So my personal take is no change in stance, no change in policy rate today. It's a wait and watch mode, but a lot of other things which will matter to the industry and the banking system and financial markets, I think that would be in.
You know, that'll be interesting, right? Because, before we just move on to the next question, just the fact that so many people are thinking about whether or not, if there is a change in stance, what could it indicate? And more importantly, so many questions that the governor will be asked in the press conference as well.
Yeah. The other thing I wanted to ask you was, 3 successive quarters of inflation beyond that 2 to 6% target band constitutes monetary policy failure. Do you think RBI runs a risk if they don't do anything preempting inflation going above that band?
Sure, a very valid point. In fact, the numbers which have come in the last 1.5 months and the next 3 inflation numbers are going to be higher than the so-called trajectory what they're targeting about. So we're expecting an inflation number around 7% for this month also, and it falls apart to something like 5% only by July. So we are seeing next 3 months data or 4 months data to be higher than what they have been projecting. In that context, April would be the policy, in my view, where they would be taking a call for the next year. How does it look like? But as of now, whether RBI would change its stance from accommodative to something, I think that would be very drastic or maybe tough thing to expect at this point of time. There are a lot of uncertainties which have come because of the global thing also suddenly out of the blue. Though not to deny this fact that the basket on fruits and vegetables and primary products have shown a massive increase. You know, the discussion in markets, or if you look at data, the milk prices at wholesale level has gone up something like 30-40%, and the fruit and vegetable basket has shown up an increase. It might come down a bit by June, July, what we expect.
And crude oil is anyways coming off.
Crude oil is coming off, so it's a balance what is going around. Whether is it transitory, and do the corporates have the pricing power now, and do you see a generalized increase in inflation? I don't think so. We have reached that stage. So in that context, what I say is, might be a mild increase in projections of the inflation. Growth, I think they will stick to 6% for the next year, which is more relevant now, what the government is talking about. So today's policy, I don't see any change in stance, neither on the rate cut scenario, which some people may be hoping. But I think April onwards, April policy would be the key one to take a call what's going to happen.
Do you think it's it's a little bit of a complicated matter, because on one hand RBI has this inflation targeting mandate, on the other hand there is that small fear that the government is okay to tolerate high prices in order to support rural income?
Yeah, so in fact I would say that this move which has happened in terms of rural pricing, the agri pricing, is one of the best things which could have happened for the economy. The terms of trade, the numbers are still we are working on. It's not so clear till now that that has materialized. But what it seems on the face of it is that this terms of trade moving from the urban to the agri sector, which has been under stress for the last 4 or 5 years, it's good. If you see some kind of pricing power coming to the industry also, that actually might be a real good thing for growth. So what you say is that, is the government willing to accept more inflation? Answer is yes, 100%. It doesn't make a difference at this point of time. In my view, the government and RBI stands on the same page. Actually, they might be okay with this mild inflation going for maybe few more months and then take a call whether it is becoming generalized and going up. So their accommodative stance in view of supporting growth would continue. And I don't see a reason of panicking about this inflation. It looks like a temporary phase and it will adjust.
Yeah, and if it are just slightly higher, as you said, maybe it's better for the rural economy as well, which in turn might help growth. The other bit is the bond markets, Manish, and lots happened between the last time that we spoke and this time, or the last policy and this time as well. Operation Twist is firmly here. Now, the governor will be asked about it if he doesn't even speak about it. What do you think the commentary of the Reserve Bank of India, I mean, either commentary, would do to the markets, if at all?
So, Neeraj, here, because I have moved out of a pure bank for last few months, I can take some liberty in saying that the biggest insider in bond markets in India is Reserve Bank of India. And what happens is, the pricing of bond yields, it's very difficult in India because of these reasons. One is demand supply. One of my favorite themes, which I always talk about, is that all the policies, investment policies in India, if you look at the insurance sector, the provident fund, they are all policy driven. They are mandated. So you really don't price the interest rates accordingly. Second thing is demand supply. There is a huge supply lined up for the next year, and it's a mammoth supply. But what also happens is that you see RBI coming in and doing, Operation Twist, etc. So there is going to be some kind of Operation Twist going on because RBI doesn't want the yields to go up so high. Second thing is what people have been talking about, the term premium they want to maintain at a certain level. So you will expect that. I think the more important thing which RBI and government is working on is this bond indice. So what we are expecting is it's not going to be a pure opening up of all the bonds and you just get into an index. So what they are working on is something specific, what they talk about special securities, or you might see open limits, completely open limits in few securities. That is the way to start with. That is how it started in China also. That could attract a lot of passive capital into bond markets. I think that would be the focus for this year. If that materializes, that really is a very, very important step in bond markets development here, because the amount of capital which, there is a question mark about next year, 2 trillion INR of disinvestment. How will we achieve it? If something doesn't come by, will this thing, help you out? If this materializes, it's going to be a very, very important change. So I'm hoping something on that in conjunction with the Operation Twist, what we talk about. So you might not see bond yields flying up so much higher because of the higher supply. These two things will keep a lid on it, but not to deny the overall thing on inflation and growth will also determine the bond yields or the term premium.
No, I mean, if indeed the disinvestment happens and if indeed some form of this global thing happens and money comes in, it's great for the currency as well. But just wondering, Manish, do you think any commentary from the Reserve Bank of India about emphatically stating, though we've seen in the last 3 policies that even after that 45 minutes of a press conference, we are left with more questions than answers. But any kind of comment from the Reserve Bank which might make the markets believe that not just for those small operation twists, but even otherwise, the RBI might indicate it is there in the market to manage the long-term yield picture, would keep yields subdued or in check. Not subdued, but in check.
Just to add to that, now they've spoken about fiscal deficit of 3.8%. In the event that, through the course of the year, we see that diverging from the path, it will have its effect on the yields. And then the RBI will need to come in and step up with its OMOs.
So RBI never comments on a policy day that they will do it or they won't do it. My take is that they would be there in the market. They will not give a commitment. So OMOs became an issue at a point of time where the liquidity is something in surplus of 2 trillion INR for the last so many months now. that is why this OMO thing is not working on it, and they had to buy the long bonds and sell the short bonds. I have my serious doubts that RBI will give a commitment in the policy today or even in the press conference. That
no indication either.
No indication. I don't think so. And I think it's not even required. The more, it's like as and when the requirement comes, we'll be there. You can expect these kind of things. Anyways, to your point, what also happens is the currency with public has started to expand at a very, very rapid pace again. That post-demon phase is completely over. So you lose around 1.5 to 2 trillion INR every year anyways, which has to be replaced either by FX buying by RBI or by the OMOs. So from that context also, if things really go. So my sense is that unless and until we see a large blow up in yields, you would not see RBI just coming up and saying, okay, I'm going to do this. So they would be off and on coming if something really goes by. So in that context, the range, what I personally see on 10-year bond, it looks like 6.5 to 7 for the next 6 months or so, rather than lowering the bond yields from here. Because worldwide also what we're seeing is some kind of traction and some kind of a halt coming here at these levels. Plus the way inflation is projected to be for next 6 months, it doesn't look like that the yields will fall so much.
Okay. Well, lots of moving parts. We'll probably get some answers, if not all, in a couple of hours from now. But Manish, so good having you as always. Thanks much for taking the time out and being with us.
Thank you. My pleasure. Thanks a lot.
Pleasure is ours entirely. We slip into a break, come back with some earning conversations.